I got him.
Oh, you got him?
It finally worked.
Oh, cool. All right,
Yep.
great.
Good morning.
There he is.
Good morning. All right. Well, I'll let you guys go. All right. Thanks,
All right.
guys.
Thank you,
Thanks,
Blake.
guys.
Thank you, Dream Team. Lakshman, welcome back to F.A.C.E.
Hi, good morning. How are you, Dale?
Doing very well. And
Excellent.
before we get started, I do want to acknowledge what you said in our first interview together and your last interview together, which was what, about 3-4 months ago, Lakshman?
Yeah, I think, was it in March? I'm blanking a little bit, but I think it was like Marchish, right?
Okay, so March is you said the stock market was going to head down, and it was one of the worst Aprils. It's pretty severe. And you were saying, tell me if I'm wrong, but we were already in a recession, and people are still trying to figure it out. So why don't you update
we
us?
didn't. Yeah, no, I don't know that we're in a recession just yet, but the observation back in March is all predicated on what we call a growth rate cycle downturn, a deceleration in growth. And so there's two different cycles. There's growth rate cycles and business cycles. Business cycle itself is the recession. That's right on deck, is what I would say.
Okay. All right. Because, now we're starting to get some pullback, Lakshman, in commodity complex. Even oil is threatening major support, and copper, economically sensitive commodities, have gotten hammered. And what's your comment on the response in the credit markets that we had basically right after the Fed? So, here was the 10-year.
Oh, and this coming down. Yeah.
And this was Fed day right here.
Yeah.
Right here.
Yeah. You're talking kind of recent history. And so,
yeah,
basically from a cyclical vantage point, again, just to set the table here, we're looking at business cycle moves. So my time frame and a lot of the comments I'm making are around the next several quarters. Okay. We'd love to forecast really far out there, and we push it as far as we can. And
put your tinfoil hat on and sit under a pyramid.
Well, look. I think if we're on a good day, maybe we get a glimpse up to a year out on some global industrial cycles, and everything else is a few quarters, couple quarters here and there. It depends if it's inflation or growth. And here, what's going on is, the market's digesting a bunch of stuff. The market's definitely, tuned into nowcasting, what I call nowcasting, kind of. And so is the Fed. So the consensus is sitting around these various nowcasts, and the latest piece of data helps them kind of update that nowcast. So you have this come off here on yields, on the longer term yields, and sure, they're looking at basically, I think, two key ingredients. One is the growth rate cycle downturn is not ending. So the longer it goes on, the more likely it turns into an outright business cycle downturn, which is a recession. And the second ingredient is that it's kind of unbelievable just how badly the Fed messed up in terms of not reacting to the inflation cycle upturn back in 2021. And then now, they're trying to make up for that mistake by being super duper tough. And, Powell envisions himself to be a reborn Volcker. And by hook or by crook, he's going to bring inflation down. So he's promising this tightening, which jacked up the front end quite a bit, as you all know. And he's not letting up on that, because inflation, even though it may be a little off its high, is still way too high, right?
Is he going to go another 75 in July?
Well, I think he's kind of locked in, because from what I understand about what their process, and from listening to what he says about his process, He's very much committed to seeing actual inflation decline in a way that convinces him that it will keep declining, right? So in my world, in business, in equities world, right, we're looking at cycle indicators. Coincident data is the target. So that would be, say, CPI growth. And he's saying, I want this coincident data to be going down for a bunch of months before I let my foot off the brake. And let's take him at his word, right?
Okay.
I think we should. So the answer to your question is, yeah, he's on this track for now.
Maybe you could explain it to me. And I understand demand destruction and, possibly why some of these commodity markets have fallen apart, like copper, and finally energy's caving. But can you explain to me why grains would fall sharply, demand destruction? Because I've been thinking about this for a long time, that we have really just one market, that they all seem to go up together, just in different magnitudes, and down together just with different degrees. It seems like everything that's traded is so financialized that it's almost positioning that determines the price. Because for wheat, let me just show you, Lakshman. You probably, I know what you do. You probably don't look at wheat prices, but this was the big story on the invasion, right? We did this. We did this.
That's a supply shock. Yep.
Yeah. So the Russians are the only ones getting wheat out of Ukraine, stealing it on trucks. Why has wheat, which the fundamentals haven't changed at all, be down here if it's not just financialization of every instrument on the board that we track?
Well, so really big picture before we go to wheat is this fundamental, there's not a lot of like truths in economics, except I'd say, I think we can, one of the things that's at play now is this idea that recession kills
inflation. Are your
inflation.
fingers crossed, right? Are your fingers crossed?
There's not a lot of truths, but there's fear and greed, right? And those things are, we all, if we take a moment and think about ourselves, are subject to fear and greed. And so the whole market is, even if it's systematized, has some of that built into it. And you have a supply shock, you're going to blow out whatever that commodity is, and you see that. And then it's kind of buy the rumor, sell the news. Now we kind of settle into it, and maybe it comes off a bit. That's all on the supply side. On the demand side, right?
Yeah.
The way I would, we do not, just to clarify, when we're forecasting inflation cycles, food is a relatively small part of the basket of what the consumer purchases, right? It
Still?
is. Yeah. I mean, look, it's right now it's the tail wagging the dog kind of situation, because the moves have been so big. But in the, when you get down to it, it's like rent and other kind of these non-discretionary things, including food. And so you see people making substitutions in terms of trying to take care of the food needs in an environment where real income growth is under a lot of pressure. So,
I used to like, having a lot of people over and having steaks, but now I have to barbecue a flat screen.
Yeah. No, I hear you. So
to make the budget. So,
Yeah, you got so again, in the inflation picture, right? So the goods stuff is not so inflationary, the tradable goods, aside from food and energy. Energy's coming on. I mean, the demand destruction is extremely real. And the supply shock layered into the demand destruction and popped things up for a bit. And I think that's now coming back down. If we move away from food for a moment, and focus in on the because food can also get knocked around, like here by war, but also by weather, for example. These are non-cyclical. These are non-cyclical events, right? But if we go into the cyclical, the endogenous stuff inside the way economies work, the ebb and flow, there's a whole, you got to go to copper, you got to go to energy, you got to go to building materials and all this other stuff. And when you go there, you see a very interesting pattern, or we see a very interesting pattern. So we've been forecasting I'm going to be very specific, a global industrial growth downturn for over a year, right? Very long time. And that has been happening, meaning that industrial production growth, IP growth globally we cover 22 economies around the world, all the major big, really rich ones, the G7s, and all the big developing ones, like all the BRICS and everything. And the IP growth in those collectively has been decelerating. Now, sensitive industrial materials price inflation. So you think oil or copper or nickel or lumber and all these things. That inflation is a very short leading indicator of global industrial growth. Now, we have long leading indicators of global industrial growth. So ergo, the long leaders lead the short leaders. And those are all moving to the downside. This is a demand destruction picture that I'm describing. And you have all of those commodities moving to the downside. And then you have the war in Ukraine. Now, immediately, the tradable commodities in particular, okay, so wheat, oil, these kind of things, they're going to go to the moon because speculators are going to see that and jump on it, right? Because they see the supply demand equation and go for it and try to get in front of it. And you saw that. So we're tracking about 18, 19 sensitive industrial materials prices. About half of them are exchange traded, and the exchange traded ones took off. They just popped straight up. The ones that are tougher to speculate on, they didn't really move, right? Because they're reading the demand destruction. They're kind of on that plane. And now you talk about the 10-year yield, talk about oil or copper. All of these are now moving to the downside. They're catching up with the non-exchange traded commodity prices that have where the growth rates have been falling. And typically they like to move together because they're based in actual economic activity. So I read this whole thing as you've got the supply shock. It's a moment inside a broader cyclical downturn. And the cyclical downturn, again, my time frame is several quarters. It's not forever. And it's also not very short term. The key takeaway here is that there's no trough in sight. That's the thing. So you could trade the wiggles, but the cyclical move to the upside is not there. And that's in sharp contrast to the spring of 2020. So if you go back to the depths of the COVID recession, a lot of these forward-looking indicators were turning up. They were bottoming. And so we were able to see the go the other way to the upside. And that's the way cycles work. Every couple of years, you get a big turn one way or the other.
I'd like to get your comment on the consumer, because you hear a lot of different stats on, their net worth because of real estate, stocks, and even, I don't know, they think people got rich collecting government funds for a year or so. I don't know how. Unless they, got in and out of Bitcoin well. But what I'm thinking is summer travel is really expensive. But when you've been locked up for 2 years, it's not stopping many people. They'll pay the 50% higher in airfares, hotel, everything. And I'm wondering if there's going to be like a day of look at where we stand financially in the fall, to where it's possible that the spending binge, which you can't blame anyone for wanting to go and enjoy life after having been, locked up. So what do you think that the consumer and we need it really is a consumer economy, right?
Yeah.
What if they wake up in the fall and they go, we can't keep spending money like this, and we have to start paying down debt?
I wouldn't say I'd say that's a primary scenario.
Okay.
I think that's one of the key scenarios, and it'll, Chairman Powell's already looking at this. He believes, I think mistakenly, that the consumer is solid.
That's all I hear.
And so he said
they
that.
Didn't talk to me.
Yeah, no, and the basic thing is you're looking at some balance sheets and you're saying, they're a little more flush with cash. Same goes for businesses. So even if we technically have a 2-quarter down or whatever, it's not going to be bad, blah, blah, blah. Right. That's the basic story. I don't buy that because we have, first, the leading indicators on the economy are moving to the downside. They're not moving to the upside. So there's no kind of bottoming just in sight yet. Second, we have leading indicators of consumer spending growth, and those are moving to the downside. You've certainly seen a lot of come down in goods consumption growth, and services is not as strong as you might think. I know we have these anecdotal stories. Look, I just did a trip, overseas, and it was a nightmare at the airport. It was pretty busy, and I think part of it had to do with probably just not enough staff. But so you get this sense of like, oh my gosh, everything is so tight. But in the aggregate, the spending numbers are actually decelerating. They're not accelerating.
There's more credit card use, right? Balances
more credit card, all kinds.
I've seen that movie.
Debt. Yeah, we know how this ends. And to be frank, we work with we work with large corporations and asset managers. Now, in the corporation side of our advisory, if you're a company, you've got a lot of embedded costs, let's say a travel company or an entertainment company, and you just need to move product, right? Because you've already set up everything. It's like a factory. You've built it all, and you need them to come. And so you can imagine if we're talking with the C-suite and we say, hey, there's a growth rate cycle downturn and there's no end in sight. What that means for a manager is that I want to sell my product as far forward as I can, right? Because that's their inventory. So now I'm going to book you on a vacation for the summer, and I'm going to get you to pay for that a couple of months ago, if not earlier. I'm going to lock you in. So now you've got a consumer who's made a purchase into the future, who's living it right now, and the sand or the ground is starting to get a little shaky, but they're still in for it, like you say. And that's a setup for the fall, after the summer travel period, for things to drop off quite a bit.
Yeah. So, and then, they're talking another great season of COVID. We have a very insightful community here.
Mm-hmm.
And
I hear that.
Charles Cook wants to know if you could compare what's going on now to any other times in history. Or are you going to say unprecedented?
Yeah. So let me do my disclaimer first, Charles, but thank you for the question. It's a great question. My disclaimer is that we do not forecast by analogy, right? I can't say, it's like the 70s or this or that, because there's so many things in the world that are different. Yeah. But we do look at our indicators, our leading indicators. We have literally over 100 of them covering 22 economies. For the United States, it's probably 14 or so, looking at different aspects of growth, different sectors, cycles in inflation, which are separate, cycles in employment, which are separate from those in growth. Looking at all of that, I think we do need to consider like early 80s stuff, because we've got inflation that's not transient. It's kind of more, it's cyclical, meaning it's pronounced, pervasive, and persistent. Endemic. We knew that back. Yeah, we knew all this back in the fall of 21, even the summer of 21. So it's really a shame that we are here. Nevertheless, we're here. And when the Fed, there's two aspects of the stimulating of the economy, the fiscal and the monetary. And we know how the fiscal really goosed up the goods purchases. And the monetary side of it did a number of things, and it only ended a couple of months ago, really. It was going all through much of this year. That's really stuck rental inflation up, which is a huge piece of your CPI. So now we've got sticky inflation. And
wages,
demand destruction is the way, and Powell kind of sees that, right? And so that's why he's saying, I wouldn't mind being remembered as a Volcker. And if you recall, you had a shorter recession in 1980, based on rates going up. Then they let their foot off the brake, and inflation shot back up. Right. And so Volcker really had to stomp on it in 81, 82. The other similarity there, and 81, 82 was a long recession. The other similarity there is it was global. It was pretty much a global recession. And when we look at our international indicators, Europe is worse off than we are. I can just say that. And when we look abroad, we over at Japan or China, the other 800-pound gorilla, they're not doing very well either. And the difficulty here is that there's no area of strength to give some support to the global economy.
Like there was in 08 when China was still strong.
Yeah, well, so 08 was a nasty recession, but China was able to stimulate like we've never seen before, right? We know that whole credit story. Yeah. They can't actually, look, they're going to try to goose it a little bit, but they don't have the room to do what they did back then. Right. They could do a fraction of what they did back then, even though they're doing something. They're different.
It's less effective per dollar.
Yeah. So Japan and China are trying to still be easy relative to other central banks around the world. And so again, we go back to the beginning of the conversation. We have a slowdown and central banks are tightening. You literally do not need to be some super duper economist to figure this out. And by the way, I don't think I'm an economist. I'm more of a student of the business cycle. We're not using models. We're looking at cyclical patterns, and it's not complicated. The economy is slowing. We're on the verge. The only thing keeping us out of recession right here is the super tight jobs market, which is keeping some jobs growth for the time being. But I wouldn't hang my hat on that. I think that's very much at risk, and therefore we ought to be thinking about what is the recession playbook. You should be thinking that through.
All right. Well, the best way to think it through and stay in touch with your work and your ideas is to go to your website, economiccycleresearchinstitute.com, or Twitter.
Well, it's businesscycle.com, and I think it's at businesscycle on Twitter.
It is.
And you're going to hear there's a bunch of people saying this and that about recession, and to be blunt, most of them don't know what they're talking about. But it's, if you use the R word, you could get somebody to click on your stuff. But look.
Yeah, I get it.
So I've been through a few of these. I'm not on camera now, but I lost quite a bit of hair for a few different recessions and recoveries. And the thing is, I really don't know of anyone who has a better track record on this stuff. I don't think we're in recession literally at the moment, but the odds are very high we're gonna get there. And the difficult thing for me, I know we'll survive it. Look, we're all going to be fine. We're going to make it through this. But the difficult thing right now for me is I don't see any good signs of an upturn. So the shortest recessions are a couple of quarters. The typical one could last several quarters. And the nasty ones can be like a year and a half.
Yeah.
And we just actually don't know right now. on the positive side, people will say, "Oh, the balance sheets are good." I would counter that on the downside, global recessions tend to be a little worse.
Yeah. Well, I'll tell you on that happy note. But you know what? You uncomplicate economics. You were talking about it's not that complicated. Thank you for uncomplicating it for our community today, Lakshman.
I'm happy to do it, and let's check in again in a few months. And
okay, we'll do that. So everyone, Lakshman Achuthan. I get it. Yep. I get it correctly.
Pretty good. Pretty good. I'll answer to that.
All right, and really, I'm so grateful to Twitter that our paths crossed.
Yes, me too.
Oh, all right, buddy. So that's a wrap, everyone. Remember, don't just count your pips, count your blessings. You could join the team in 15 minutes on the Morning Edge. Let's have a great week. And God, what a way for me to kick it off after being off yesterday. Thank you again, Lakshman.
All right, thank you.
Adios, everyone.
Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.